Hey everybody, it is Saturday, June 11th, 2016, and this is Brian Shannon speaking from alphatrends.net. Hope you had a good week of trading. The markets are starting to show a little bit of signs that they're getting tired here and slowing down. So the S&P this week lost a little bit of ground, as did the NASDAQ. Biotechs, which have been the weakest all year, really fell apart. And bonds had a very good week as they continue to make interest rates lower here. So let's take a look at oil first. Oil on the weekly chart that we're looking at here, you can see that, let's take a look at just a simple trend line. I mean, I'll draw it in blue, I guess. I can change it to red. But, this has been a band of potential resistance that we've been talking about near the 50 level. It's had a spectacular run, almost doubling, getting up to this level. And I think what's possible here is that we kind of, trade around in this area a little bit, probably suck in shorts a little bit early here, and then maybe come back down and create a right shoulder. And that's a potential scenario for oil. But let's take a look at the equities and look at the ETFs and see where we are. So the S&P 500 obviously lost some bigger ground on Friday, and with that gap lower and continuation. I had pointed out on Twitter that we have a couple of things coming together in this 209 area. Number one, it had been support over here on several occasions just in the last month. We also see that in addition to this support, what I have is I've drawn in a volume weighted average price just by clicking there with the volume weighted average price tool. And so since the low in May, we have the volume weighted average price coming in right into this area as well, saying that the average price since this rally is in that area. The third thing that I had pointed out was the Fibonacci level, that from this low taking up to here, a 38.2% retracement, and you can see that over here on the left hand side, a 38.2% retracement, 50%, 61.8. This 38.2% retracement comes right in at that 209 level as well. So heading into next week, we still have an uptrend on the daily time frame. There's, that's undisputable. We had broken to the highs from the fourth quarter of last year. So we'll look at, this is now a 2-day chart, meaning that each candle here represents 2 days. But we had broken through that and then had sold off. So again, as always, when a market breaks out, as people will say, it's not really a breakout if it's run 2 weeks ahead of that, or not a breakout that should be trusted. You have to ask yourself, where has it come from? Now, I don't think that the rally is over in the S&P 500. We have a rising 10, 20, and 50-day moving average on the daily time frame. However, we did see a failed breakout, and now we're below a declining 5-day moving average. So that tells me heading into next week, we have to expect that, perhaps we'll drift down towards this 209 level, and it's a potential level of support. It doesn't mean it will become support. It's certainly the potential for support in there. Possibly we pull back down a little bit deeper towards the 50-day moving average. Now, I don't follow news a lot, but with the Brexit coming up, the vote in 2 weeks, markets might be nervous a little bit ahead of that, and that's just a fundamental reason that maybe people are looking at this market a little bit more cautiously in time to take profits. But, as long as we remain below a declining 5-day moving average going into next week, you're going to have to be very distrusting of the long side for initiating new positions. Now, of course, it's each individual stock trades on its own merits, but we have to consider the the mixed messages of the market here. Longer term, clearly still an uptrend. Intermediate term suggests that we have a little bit more cautiousness going into next week. And I had started to tell subscribers that on Thursday that we, with that gap lower, and yes, it found support at the 5-day moving average, it was turning light a little bit more cautious because we had trouble with that breakout level. And now that we have it below declining 5-day moving average, it's a little bit more of a red light in the intermediate term. What it would take to change that would be for the market to get back up above 211.50 and to close above there. So right now I see us going into next week as potential for support near 209, guilty till proven proven innocent until we can get back above 211.50. For the Nasdaq, this market obviously here on this 15-minute chart, and if you're not familiar with the charts that I use, then just look up in here if you're not familiar, or if you're wondering what time frame I'm on, as I do switch between them quite a bit. Anyway, here on the daily time frame, what we see is we came down pretty much to the conjunction of the rising 20 and 50-day moving average. Let's look at that on a 30-minute time frame now, so that we can take a similar look as we did with the S&P 500 and put the Fibonacci on there. So basically, a retracement tells us that it's a healthy retracement down to a 38, even as far as a 61.8% retracement. And we came close to the 38.2% retracement at about 108.50. And we are also, of course, right on the 20 and 50-day moving averages. So we're at a potential level of support for the NASDAQ, but it can't be trusted yet, not with a declining 5-day moving average, and especially when we see that we have lower highs and lower lows below that declining 5-day moving average. For the NASDAQ to become healthy again, it's going to really have to get back above this level. This is now potential resistance, so we're going to need to see it back really above 110 and a quarter for the intermediate term trend to be considered healthy again. So, the markets are just saying be a little bit cautious. We've been talking about this cup and handle formation for a bit, and it hasn't broken that. So maybe it's going to turn into an ascending triangle with a tighter range. But the fact is, for heading into next week, we have to start out on a cautious note. Same is true for the Russell 2000, of course. In this market, this has been a leading group that it broke beyond all the levels that were supposed to be resistance. We were supposed to see resistance right here at this prior support. It blasted through it. This was a potential level of resistance. Some people shorted against it, and in my mind, they got what they deserve, because you don't want to sell short while we have a rising 5-day moving average. And since mid-May, we've been above, this market has held beautifully above a rising 5-day moving average and has been innocent till proven guilty. It turned more cautious on Thursday and more bearish on the intermediate term on Friday as it made lower highs and lower lows. So that tells us, again, what we want to look at is potential levels of support. From this low here to this high, a 38.2% retracement takes us right into here. Well, that's also, where we saw this prior resistance. So let's just back this all up a little bit. And, this prior resistance has the potential to become support also at that 38.2% retracement. It doesn't mean it will find support. What it tells us is that's a potential level where we want to be alert and look for shorter term time frames to look for the actual evidence of a turn before we get involved. We don't want to just blindly stick bids in at Fibonacci levels or moving averages. To me, that's not the proper way to do it. Let other people do that, and once the evidence is actually there that the market is making a stand and getting ready to turn, then you anticipate a little bit, wait for price confirmation before you actually participate. And as you have a good rally, you stay with it. If you don't like the fact that it's up too much, then sidelines is always better than fighting the momentum. Semiconductors broke down a little bit here. I guess you could say finally, because they've been really the leaders, and it's had this tremendous run that has just destroyed short sellers, and people have been fighting it all the way up. And now we finally see that it broke below an important level, below that declining 5-day moving average, and it's that dragged the 5-day moving average lower. It's been innocent till proven guilty for the better part of the last 3 weeks or so, once it really showed that pattern of higher highs and higher lows with a rising 5-day moving average. Stage 2 uptrend. This was stage 1 accumulation, indecision. This looks like stage 3 distribution, and possibly I think what we could see happen in these semiconductors is maybe rally back up here a little bit, get people confident again, and then for the bigger trade to unwind to the downside. Now, when we look at Fibonacci off of this, we'll just do it on a 60-minute chart. I don't prefer 60-minute charts. I prefer 65. I've written about that in the past, but a 38.2% retracement would get us down into this area where we can see on the daily time frame is basically the prior resistance in here. So 50, 55, 55 and a half is going to be an important level to see these semiconductors if they continue to pull back down towards that level. It seems like a logical place where it has the potential for support to be found. The big mess, of course, continues to be these biotech stocks. I've been bullish on these for the last couple weeks, thinking that they could get up towards this level, and then became cautious as, of course, what happened as we broke back below that 5-day moving average. That implied caution. And then when it broke support and made a pattern of lower highs and lower lows, this is where, in my mind, they turned negative this week. You could say, well, they turned negative here with that gap lower. True, but you had confirmation of weakness over in here. Plenty of time to get out of a long position before the bigger breakdown, and this is inexcusable to hold through those, I think, if you're a trader, as I am. So the biotechs are, they're still a mess. They're back below the year-to-date volume weighted average price. They're below the 10, 20 and 50-day moving average. In the bigger picture here, they're really, range bound. They made it to the top end of the range, and now are we going to go all the way down to the low end of the range, or is this going to be consolidation? To me, I think the biotechs going into next week are a waste of time. Let's talk about Apple. Apple is kind of set up a little bit interesting here. When we look at the weekly time frame, we see a clear pattern here of lower highs and lower lows. And we've made this rally, and now where this rally is at this point has the potential to become another lower high. So when we look at the daily time frame, and we'll put on, for instance, the year-to-date volume weighted average price that has been important for this stock, quite a bit this year actually, as resistance early on, and then we broke above it, and here it's seemingly acting as resistance with a declining 50-day moving average as well. So I look at this and I think, well, we have the potential for a breakdown here. That things are, you can look at it as, is it consolidating before the next move higher? With a declining 50-day moving average, I tend not to trust the rally attempts. So I'm looking at this saying, if Apple gets back below this, 98.50-ish this week, I think you could be short with a stop just above here, or if you wanted to give it, more room just at that level. And I think that Apple has the potential to come back down at least into, the 93, 94-ish area. Let's talk about the TLT, which is, of course, the bonds, and we spoke about these, that they were breaking that trend line, and that trend line was broken last week, and here we see just great upside continuation in bonds as the bull market in bonds continues to show its hand. We had some great winners in Alpha Trends this week. We had BEAV was a real nice one, BEAV. We bought that one right here as it started to break higher. We took half off, I believe, right in here, and we're stopped out of the balance maybe at that point. FLS was a nice one, and these are, we talk about individual stocks each and every day in Alpha Trends. We bought it right here as it was breaking, got stopped out of the balance on Friday right here as it broke below this low. We had gotten long shares of Triple D. In that one, we had gotten long, I believe it was about this, right on this day, actually. And we got stopped out on this day, right before the bigger decline. These are the strategies, the techniques that we talk about every day. I think we lost 15 cents on Triple D after holding it for maybe 2 days, right in here, getting stopped out that day before the bigger decline. So if you listen to price action, not every trade's a winner. This was a small loser, but it's nice to avoid these bigger losses as well. And the way you do that is to have a consistent trading methodology based on market structure. That's how we got short shares of GME as this one broke down this week, and we're still short a very small position in it. But, these are the types of trades I bring to subscribers every single day. Take a look at alphatrends.net. Thanks for tuning in.